So what really makes stock prices move? You know how it is. 1 minute a stock's up, the next it's way down. It can feel like a complete and total mystery. But what if I told you there are really just 4 key things driving almost every single change? Let's dive in and figure this out. I mean, if you've ever stared at a stock chart and just thought, this looks like total chaos, you are definitely not alone. But here's the thing, it's not. There's actually a method to the madness, and in the next couple of minutes, we are going to crack the code together. So it all pretty much boils down to these 4 things. You've got the company's performance, what's going on in the news, simple supply and demand, and of course, investor emotion. Just think of these as the 4 main forces that are constantly pushing and pulling on a stock's price. Once you get these, the market starts to make a whole lot more sense. All right, first up, let's talk about the most fundamental driver of them all, the company's actual performance. The easiest way to think about this is like a school report card. Is the company getting A's, or is it kind of failing the class?
And that grade is what Wall Street calls earnings. It's the bottom line number. After you subtract all the costs and all the expenses, how much profit is the company actually making? This right here is the absolute core measure of a company's financial health.
The connection here is pretty direct. If a company makes more money than everybody expected, its stock is seen as more valuable. And yep, the price tends to go up. But if it misses those big targets, the price almost always drops. It's that simple. And listen, this isn't some abstract financial theory. Let's just think about McDonald's. If they come out and say they're selling a record number of McMacs and fries, their earnings report is going to look fantastic. Investors see that success, they all want to buy in, and that pushes the price higher. Okay, let's move on to our second driver. This is where things get really interesting, because a company doesn't exist in a bubble. What's happening in the world, what you're reading in the daily headlines, can have a huge, and I mean huge, and immediate impact on its stock price. So, good news, right? Like a successful product launch, that makes investors feel optimistic. But bad news, like a big lawsuit or a data breach, that creates pessimism. And that feeling, that sentiment, translates directly into people either buying or selling the stock. Just think about it. When Apple gets on stage and unveils a brand new iPhone that everyone is excited about, the stock price often climbs just in anticipation of all those future sales. But on the flip side, if Tesla has to recall thousands of cars, investors get worried about the cost, about the damage to the brand, and that can cause the price to fall. All right, on to our third driver, which is just pure classic economics. Honestly, you can think of this one as a massive popularity contest that's happening on Wall Street every single second of every day. At its very heart, a stock's price is just the point where buyers and sellers agree on a value. It's a constant balancing act between the number of shares that are available for sale, that's your supply, and the number of people who want to buy those shares, that's the demand. It's really simple when you break it down. If more people are trying to buy a stock than sell it, well, the buyers have to offer more money to get a piece, and the price gets pushed up. But if everybody is trying to sell at once, they have to lower their asking price to find a buyer, and the price goes down. Here's a perfect real-world way to think about it. When a super limited edition Nike sneaker drops online and it sells out in like 2 minutes, what does that tell you? It tells you the brand is hot, right? That demand is completely off the charts. Well, investors see that same exact hype and think, hey, I want a piece of that company. And that can drive up the demand for the stock itself. And that brings us to our fourth and final driver. And this one is often the wildest, most unpredictable of them all, simple human emotion. Because let's face it, behind every single trade is a person. And people, well, we aren't always rational. Sometimes just one single powerful feeling can completely take over the entire conversation around a stock. Logic, earnings, news, all of that can get thrown right out the window, replaced by just pure, uncut hype. And this creates what is basically an emotional roller coaster. Hype can spark a buying frenzy, where people just start buying a stock because everyone else is doing it, sending the price into the stratosphere. But fear is just as powerful. It can trigger a full-on panic, where everyone rushes for the exits, causing the price to absolutely plummet. And we all remember the ultimate example of this, right? The whole GameStop saga wasn't driven by company earnings reports or some big news story. Nope, it was fueled by social media, by a sense of community, and just this powerful wave of pure emotion, pure hype that took that stock on one of the wildest rides in market history. Okay, so now that you know the 4 big drivers, let's put that knowledge to the test.
I'm going to throw a few real-world headlines at you, and you can try to guess which way the stock price might move based on the framework we just built. Ready?
First step, Netflix loses 2 million subscribers. What do you think? If you guessed price down, you are spot on. This is a crystal clear signal of poor company performance. I mean, fewer subscribers means less money coming in, and that's a huge red flag for investors. Okay, next one. Walmart announces plans to open 150 new stores. What's your call? That's right, price up. This is a classic piece of positive news. It signals growth, it signals confidence from the company's leadership. Investors love to see that.
And last one for you. A major Disney movie flops at the box office. This one would almost certainly be priced down. See, for a company like Disney, movies are a key product. So a major flop is another perfect example of poor company performance because it hits their bottom line, their earnings, directly.
And just like that, you've done it. Seriously. You now have the fundamental toolkit to decode what's happening in the stock market. It's not some random magic show. It's just this dynamic dance between these four understandable forces.
So let's just recap them one last time real quick. You've got the company's report card, its performance, the daily headlines, news and events, the Wall Street popularity contest, supply and demand, and of course the wild card, investor emotion. So the next time you see a headline about a company or see a stock price jumping all over the place, you'll have the framework to actually understand why. You'll be able to ask yourself, which of the four drivers is at play right now? Is this meaningful news or is it all just noise? Thanks for tuning in.